All right, I'm just going to check really quick if everyone who has dialed in on the computer can hear me okay, and we'll get started. You just toss a little note in the message for me. Perfect, thanks guys. So welcome, Director's Cut. It's September 14th and fall is officially hit. So I'll let it over to Lynn and to give you the latest numbers.
All right, thank you, Katie. I'm not sure what the measure of fall officially hitting is in North Dakota, but that's good to know. So we're talking July numbers due to the 2-month lag of accumulating the data and reporting it. We were excited to report that North Dakota has set a new record in oil production, 1.27 million barrels a day, 1,269,366 to be exact. That's a new all-time high, 3.5% increase from the June numbers, about 42,000 barrels a day of increase. And in a few moments, I'll talk about the kind of the downside of that. Interestingly enough, only an eighth of that was on Fort Berthold Reservation. So you remember we talked a month ago about the gas gathering, gas capture challenges on Fort Berthold and how industry continues to struggle with that. And so you can see that they moved the completions and production outside of Fort Berthold, but still we're going to experience some difficulties with gas capture. Gas, of course, associated gas, so it's at an all-time new high as well, up 4.3%. So again, gas continues to outpace oil increases, 42,000 barrel a day increase in oil, almost 99 million cubic feet a day of gas increase on a daily basis. So more than twice the increase in rate, and that continues to challenge the state and the industry. We set an all-time new high in terms of the number of wells producing, and we're seeing still significant permitting numbers and the rig count. Talking about the rig count, we are in the mid-60s. We are at 65 today. Again, that low to mid-60s number represents the gas capture challenges. Industry's target would be to be at 70 by the end of the year, but under the current paradigm, there aren't enough frac crews and there's not enough gas processing and gathering capacity to manage that number of rigs. So we're somewhat stuck in that mid to low 60s, regardless of how robust the oil prices are. Looking at world supply and demand a little bit, and at U.S. storage volumes. U.S. storage volumes are really at a very low point, and EIA has been publishing that, and the crude oil storage volumes have been dropping pretty dramatically. They're well below the average for this time of year. That would be a concern, except that now with EIA announcing that U.S. is the #1 oil producer in the world, producing just under 11 million barrels a day, not as much storage is needed, obviously. If you have that kind of daily production capacity, the refineries can take advantage of that, and they don't need to store as much crude oil in surface facilities, and so that is there. I took a look at shares of world production. Supply and demand are essentially in balance right at this point. You're seeing some price increases, and I guess Justin will talk about Brent prices versus WTI prices, so if you want to save those questions for him. But we're essentially in balance at this point, and we're in the price range that OPEC has sought, in that $70 to $80 per barrel range, which they've tried to manage production to achieve that. The world produces 84 million barrels of crude oil a day. 33 million of that's coming out of OPEC, 11 out of Russia, and 11 out of the US. Interesting that 2/3 of the world's oil supply then is concentrated in those three entities. And so that creates an interesting paradigm in that a disruption in any one of those or overproduction in any one of those areas is going to drive quite a bit of volatility in terms of oil prices. And so when you concentrate supply like that, you can tend to get fairly volatile in terms of oil prices. And so we might expect the markets to be pretty reactive over the next few months of news coming out of OPEC or Russia or the US. For example, the Iranian sanctions, the markets react pretty strongly to things like that. We had great weather in July. The wells waiting on completion went down, so the frac crews really outperformed the norm. The inactive well count up just a tiny bit, but pretty much flat. So still below the record levels, but not dropping as quickly as we had really hoped and anticipated. And so kind of referring that back to production, we saw production from conventional wells actually decline to about 53,000 barrels a day, still at 4% of our total production. And so that's really where the inactive well count resides, is in the older conventional resource wells. And we're just really not seeing those wells come back into the market, into the supply. Everything is fairly stable on Fort Berthold in terms of 2 more rigs, a few less wells waiting on completion. But I really want to call attention to the increase in drilling permits. The number of wells permitted from June to July jumped by 174. And so you can see that industry has big plans. They like the geology on Fort Berthold Reservation. And so the permitting activity there has been very, very high. The only restriction would be gas capture. That's what's going to control or restrict production from Fort Berthold. So talking about gas capture, we lost another 1%. Statewide gas capture fell to 82%. As you know, the commission has set the goal for Bakken at 85, and Bakken stayed at 84. So we're not meeting the commission's gas capture goals. We're still processing individual companies, and we've got an important employee out on maternity leave, so we're a little bit slow about getting that information processed and getting it out to you. But I promise we'll get that information out as quickly as we can about individual companies and production restrictions and gas capture improvement plans and all of that. But we did lose a percentage statewide Bakken, and we're 1% below the commission goals. We are 4% below on the fee Fort Berthold reservation and 3% below on the reservation in total. We had some significant downtime of the Robinson Lake gas plant in July. They were doing a lot of maintenance work and upgrade work. And so I think that's the big driver. So that may lead to force majeure for a lot of those producers, and they may not have production restrictions as a result. Looking at the path forward, with gas capture not meeting the goals, with the goals increasing to 88% on the 1st of November, and the struggle that we're experiencing, the commission has started to look at what are some possible alternative solutions. And so this morning, the Industrial Commission approved a $140,000 project for the Energy and Environmental Research Center, EERC, at Grand Forks, to investigate produced gas storage and to report it back to the commission. We've done some relatively simple modeling of that concept here at the Oil and Gas Division, and it looks like it's geologically feasible. And so they're going to look at the technology, what formation would be the most, or formations would be the most suitable, what kind of regulatory or statutory problems might there be that need to go to the legislature. And that report's due by the end of the year, so it's due in December. And so we are looking forward to being the first state in the nation to actually capture produced gas and geologically store it to help the industry with the gathering and processing of natural gas. So it would be produced gas in its pre-processed state, actually being pumped into a geologic formation and temporarily stored for 2 to 5 years to help smooth out this disconnect that we have between production and infrastructure. We don't want to discourage infrastructure investment, but at the same time, we want to encourage oil production growth, and we've got to find some innovative solutions to fill that gap between increasing oil and gas production and the time that it takes to finance and construct gathering and processing. Also, in the long term, we understand that we're going to have a difficulty with transmission capacity out of the state. And so this might be a solution when we reach that point as well. So we're excited about that and looking forward to having some results that we can report to you about how we might be able to use some of the great rock that we have in North Dakota to temporarily store produced gas. A much better solution than flaring it, obviously, because flaring destroys the gas and reduces the value to zero. So we're hoping that we can be innovative with this stuff. On the federal front, there's been quite a few things happen in the last month. The Bureau of Land Management announced that, well, on the Bureau of Land Management front, briefs were due in the 10th Circuit on the BLM venting and flaring rules. And so North Dakota filed briefs day before yesterday in that ongoing litigation that's taking place between BLM, California, New Mexico, North Dakota, Texas, Montana, a lot of states involved in that. On the EPA front, EPA proposed a new rule called the Affordable Clean Energy Plan, or ACE, to replace the Clean Power Plan. And I just want to draw that to your attention because that's affects our coal industry and potentially affects sources of carbon dioxide for enhanced oil recovery. And then EPA also announced August 24th that they're going to reprioritize their enforcement efforts to no longer prioritize fossil fuels like the oil and gas industry, but to prioritize based on environmental effects. So they will look at things like air pollution and broad environmental problems, but not focus on industry sectors anymore. And then finally, EPA just announced day before yesterday that they're a new proposal to amend the June of 2016 proposal for methane emission reductions. And I don't have the final rule, it hasn't been published in the Federal Register, but there's going to be a comment period, and I provided the information on where to look and how to comment on that proposed suite of rules. So quite a bit of activity on the federal front too. But really, the big news, record number of wells, record oil production, record gas production, and an ongoing struggle with gas capture, with hopefully some very innovative thinking and technology application where North Dakota would be the first to do aquifer storage or geologic storage of produced gas. That's the director's report, so we'll take questions, Katie. You want to manage questions? I
do have one question here. How many frac crews are there now? How many are needed to increase rigs above 70?
So the survey that I do indicated that we've got 41 frac crews operating. And so to push rigs above 70, we really have to get to 45, 46 frac crews. So we're 5 frac crews short of keeping up with 70 rigs. We're just about perfectly balanced at 40 to 41 frac crews and 65 rigs. That's almost the exact ratio at which they can do the work. So that is an interesting thing in that we're just keeping up with the rig count. If they increase that rig count beyond the 65, we'll start to build non-completed wells again. So,
any questions in the room?
Yes, just so I have it, define produced gas for me.
oh, thank you. So the question from the room here was define produced gas, and our definition of that would be gas prior to the custody transfer point. So this would be the gas that comes off of the field separator and the vapors off the oil storage tanks before it goes through a sales meter and goes into a gathering system. So it would have the liquids removed from it. It won't have condensate or things like that in it, but it will still have all the natural gas liquids in it. So it'll be a field gas with all the components in it before it goes to a sales meter.
So not to put too fine a point on it, there's a difference between produced gas and processed gas.
Yes, there is, and there are a lot of federal regulations and a lot of. And the question was difference between produced and processed. So a lot of federal regulations and a lot of history, decades of history of processed gas storage. But processed gas is methane and ethane. That's all that's left in it. And so the major transmission lines that move that around have massive gas storage, geologic storage and salt cavern storage in Michigan and Kansas and on the Gulf Coast and even over in Montana. But that gas has already gone through a gathering and a processing plant, and it's had all the liquid components, the NGLs removed, and is mostly methane with a little bit of ethane.
Yeah, no, but go ahead.
Well, just wondering if at this point, do you anticipate any production restrictions because of the flaring?
Question was, do I anticipate production restrictions? And I'll be surprised if there aren't some. With those kind of flaring numbers and production increases, I would expect there to be some companies subject to production restrictions. I was a bit surprised last month that there weren't any. Now the caveat to that will be, was it force majeure at the Robinson Lake plant that caused us to lose that, to fall below that 85%? If indeed it was force majeure and they're able to use that, then that would relieve them of the restrictions. But at these kind of volumes, I would expect there to be restrictions.
A follow-up question on the gas storage project that was recently announced. How much of that gas stored would be recoverable?
Yeah, so the project that was recently announced, like,
or the project proposal to investigate produced gas storage.
Okay, great question. And so again, we just have a very preliminary, fairly crude model for that. It shows that about 70% of the gas will be recovered in that 2 to 3 year time frame, and then diminishing amounts of it, but at least 70%. And that's a gross number without doing anything to try to tweak the technology. That's just a put it down a well and take it back out. So I think we can improve on that. But that's what the model shows at the present, without EERC doing any really good characterization work or even looking geologically at a best place to put it. So in that case where we ran that model run, all we looked at was putting in a typical plain vanilla Broom Creek formation location with no structure or anything. Just put a well down, put it in the ground, and then take it back out. If you optimize the geology and the well design, you should be able to improve on that substantially.
Got one other question, follow-up from Luke Johnson. What accounted for the drop in uncompleted well counts? Could it be efficiencies or operators turning their attention to those uncompleted wells?
Sure. So we think that the drop June to July was the fact that we saw a drop in rig count July to August. So we saw industry scaling back on the rig count and adding 1 or 2 frac crews. And so they were able to pick up a small number and slightly reduce that number down 50, not a lot, but down 5%. And so we saw them at that point in time scaling back on rigs and able to scale up a little bit on frac crews, and that's just some of that variability. But the new norm, industry's telling me, is 850 to 900 wells in that bank account for as long as they can foresee activity going on. The real struggle, and we talked about it this morning with the Industrial Commission, there's two areas where industry is really struggling with workforce. One is skilled frac crews, and we've seen that, just an inability to grow that count much beyond 40. And then the other area has been in fabricating gas plants and constructing gas plants. And so as we informed the commission this morning, the Little Missouri 4 gas plant has been delayed in terms of its startup because they've been able to hire less than half of the fabricators of what they felt they needed and wanted to bring that project in on time. So they're behind, and the plant was hoping to begin startup in November and be at full capacity in January. It's now targeting startup in April of next year. So you can see two areas where we really need additional skilled workforce.
Any other questions in the room?
Thank you for your time.
We'll let Justin get set up.
There we go. You all ready on your end? Okay. Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. Get right into the standard update here. Taking a look at Williston Basin production around the region. Continued declines in the two neighboring states that share our transportation network. And then obviously, as you just heard from Lynn, the significant increase in oil production for North Dakota. When we look at the rate of change month to month, again, both oil and gas, significant increases in both of those categories. Not the highest in either category, but still very substantial. I should note too, on the previous slide 2, 0 rigs active in eastern Montana, but there is 1 rig now active in South Dakota, vertical rig. Don't have any additional details on that, but I'll continue to watch. I don't anticipate any near-term major shifts in production from that area, but I thought it was worth noting. So moving ahead to slide 4 then, again, looking at the overall movements of oil from the region, some slight shuffling around again. We saw increasing market share, not only in pipelines, but also on the rail side. And that was primarily due to less barrels being transported north into Canada. So again, kind of a unique set of circumstances. When we look at the longer-term trends, again, pipelines continue to dominate the market share of movements out of North Dakota. We will touch here in a moment on this Brent WTI dynamic that has had some major shifts here over the last couple of weeks. On slide 6, this is what I'm just alluding to. So again, we saw throughout late 17, early first part of 2018, that Brent WTI spread widening and some additional incentives to utilize crude by rail out of North Dakota. It was in July or late June that really tightened up again, and now we're seeing here in September that's starting to widen again. And so that is definitely above that kind of rough trigger point that I keep an eye on, of $5 to $6 spread between Brent and WTI. It's at that point where, at least historically, we've seen some trends where the industry will start moving available barrels on the rail network as opposed to the pipeline network. So we'll keep an eye on this dynamic. Again, this is September pricing. The things we're talking about now is July transportation. So we'll have to keep all this in the back of our minds as we move forward and how this may have impacted decisions out of the region. Regardless, on slide 7, we did see an estimated increase in utilization of rail out of the region. With that strong increase in oil production from the region, as well as fewer barrels being transported north by truck, it just, again, the estimates worked out that a net increase in overall movements by rail from the region. And then the destinations of these from the EIA market share calculations, again, east and west coast, primarily the west coast, at least through the month of June. Then slide 9, just an update on pricing. Again, you'll notice for June that east and west coast, PAD 1, PAD 5, very, very close, very tight pricing difference. The one advantage, if we'll call it that, to the west coast is that it is a shorter rail route from North Dakota. It's also a single carrier rail route as opposed to going to the east coast. Typically, they'll have to change carriers, and there's a little bit of additional transportation costs going east, and so that all factors into some of those decisions on the marketing side. Where we sit as of today, this morning, again, north of $9 at Brent WTI spread, and then LLS, which again is that light sweet barrel down in the Gulf Coast. Real strong pricing there relative to WTI as well, over $7.50 premium to Cushing for that barrel at the Gulf Coast. And then slide 11, this is just that truck movement north and south. We saw continued strength in barrels coming into North Dakota being reported, as well as a decrease then in barrels being moved north. Again, not a lot of color of what's exactly taking place from a marketing standpoint. We know that in July there was relatively strong pricing in North Dakota. The North Dakota average discounted WTI in July was around $3, which is a pretty strong market for North Dakota. And so whether some of those barrels were coming in to take advantage of some of the better pricing in North Dakota, that was just one theory I have at this point. Slide 12 now, shifting into the natural gas side of the world. We saw a 1% increase on the non-confidential wells, and it took place in that blue piece of the pie, which is flaring from wells that don't have a pipeline connection associated with them. And so typically that stays fairly low. But if we look at slide 13, we have seen in the last couple of months, month over month, 1% increases in that category of wells not connected to sales lines. So that, if we look at slide 14, this may start to tell a little bit of the tale of what may be taking place. So new wells producing gas and new wells selling gas. And so again, the industry goal would be to have these tied hand in hand, where new wells producing gas would also be connected immediately to a sales line. But when you look at the hard numbers, we've seen several times now in 2018 where the number of new producing wells for gas is exceeding new gas sales connections. And so that just sets the stage for a scenario of wells that are simply just not getting connected to the system fast enough, and gas being flared associated with those wells. So I think that is a real good indicator to continue to watch for how this may evolve. And then slide 15, looking at gas processing plant capacity in the region. Again, this is an updated version with that delayed in-service for the LM4 facility. You'll notice with the increased gas production, as well as the delay in that particular project, now looking at a scenario where, again, at least in my high case outlook, it won't be until late 2019 that gas processing will catch up with production levels in the state. So again, not that the industry is required to capture 100%, but it's just a good indicator to watch of the positioning of the plant capacity and how that ties into overall production and capture rates in the state. So again, very challenging times ahead for the next 12 months or so, for sure, as the industry continues to wrestle with the gas capture requirements. And then looking longer term ahead, the industry catching up with plant capacity in late 2019, and then production expected to exceed it again in the early 2020s. And so that we're looking at what type of additional investments will be needed longer term from the region. And then last but not least, I'll quickly mention this morning, I updated the Industrial Commission. If there's anyone that's interested, there's some new work on that online presentation about Bakken longevity, remaining inventory of wells that potentially could be drilled in the Bakken Three Forks. So if you're interested, check that out on the website and reach out to me if you have any questions. So with that, glad to answer any other questions.
You went Bakken Three Fork, right?
Yes, good catch. Three Forks, yes. So we're very quickly trying to get ready for this afternoon.
Do you remember offhand what was the highest flaring percentage in North Dakota?
I don't have to do either.
Highest flaring percentage?
Yeah.
36%,
36%.
64% capture.
Any questions? Feel free to enter them in the chat room as well. So far, it's pretty quiet.
Has there been any further announcements of at least talking about new gas plants in North Dakota? You know?
Nothing publicly. The companies are all recognized very well what type of production potential the region has, and so now it's a timing scenario, a scale scenario that they're trying to work through. Again, what's the appropriate size, the location of any new facilities? Those are things that are being worked out as we speak.
But nothing for prime time yet.
Not yet, but I wouldn't think it'd be too long before we start hearing some additional news on that front.
Any other questions?
Okay, well, thank you very much.
That wraps it up. All right, thanks so much, guys.
Thank you.
Thank you.